We're jumping straight into Coherent today. Everyone is watching the price action, but the real story is the AI optical networking supercycle and their addition to the S&P 500.
Exactly. You're tuned into the Easy Money Show, where we make sense of the market's biggest moves. I'm glad you're with us.
And real quick before we get going, remember to subscribe and hit the like button. It really helps us out.
It definitely does.
So today we're looking at Coherent, mostly pulling from their Q2 fiscal 2026 earnings and some recent supply chain data to see if this crazy momentum is actually justified.
Yeah, because if you were watching the boards yesterday, March 10th, 2026, it was wild.
Completely wild. The stock climbed 7.02%. And it wasn't just them, right?
No, not at all. It was an unprecedented multi-day rally across the whole optical tech sector. I mean, Sienna surged 9%.
The momentum jumped 8%.
Right. But Coherent had this extra layer of fuel.
The index inclusion.
Exactly. Just on the news that they were being added to the S&P 500, alongside Lumentum, the stock jumped 4.8% intraday.
Which caps off an insane 85% run over the past year.
It really highlights a massive psychological shift.
Yeah, a shift straight toward this hyperscaler-driven upside. So for the investors watching this explosive growth, what does it actually mean? Let's break that down even further.
Well, when you look at those recent Q2 numbers, their financial engine is just highly optimized right now. They hit $1.69 billion in revenue.
Which is up 17% year over year, right?
It is, yeah. But you really have to peel back a layer. They recently divested their aerospace and defense business.
Right, they sold it off.
Exactly. So if you look at the pro forma numbers, just the core business lines they kept revenue, actually grew 22%.
22% organic growth for a hardware company at this scale is huge.
It's massive.
But the internal composition of that 22% is what I found so interesting. The networking segment has basically eaten the whole company.
Yeah, it's driving over 70% of total revenue now.
Because they are just aggressively pumping out those 800G and 1.6T optical transceivers.
The exact hardware eliminating the data bottlenecks in AI clusters right now.
Exactly. The market always fixates on compute power. You know, the GPUs.
The brains of the operation.
Right, but when you're clustering tens of thousands of GPUs together, the electrical to optical conversion is the actual gating factor. If they can't talk to each other fast enough, the system lags.
And that shift toward those premium AI components is so visible in their profitability.
Oh, absolutely. Non-GAAP gross margins expanded to 39%.
Up 77 basis points year over year.
And then non-GAAP earnings per share jumped 35% to $1.29.
Beating the street by 14 cents.
Which is just a testament to Jim Anderson, their CEO.
Yeah, those numbers reflect his very deliberate turnaround strategy. His whole operating philosophy has been speed to market.
Hyperscaler CapEx cycles move incredibly fast.
They really do, and Anderson recognized they needed a much leaner operational structure to capture that specific demand.
Which meant cleaning up the balance sheet.
That was step one. In 2025, they slashed their debt load by over $400 million.
And the vast majority of that, over $380 million, came straight from dumping the aerospace and defense segment.
Right.
But I want to play devil's advocate here for a second.
Sure, go for it.
Selling off a stable defense contract-backed division to go all in on highly cyclical optical networking, that's a bold move.
It's very aggressive.
It worked, clearly. Dropping that asset generated the free cash flow to push their net debt-to-EBITDA ratio down to a really healthy 1.7x.
And honestly, that specific deleveraging is probably why they secured the S&P 500 spot.
Oh, without a doubt.
Yeah.
The index committees want financial stability, not just top-line hype. They narrowed their 2025 fiscal year losses by 71%.
Down to negative 80.56 million?
Right, proving they have the financial discipline.
But still, does abandoning defense revenue leave them entirely at the mercy of AI hyperscaler budgets?
It definitely increases concentration risk. There's no denying that.
Yeah. But the strategic rationale is that they needed pure play focus. A clean balance sheet isn't just about index inclusion. It's about having the unencumbered capital to build out severe capacity expansions.
You can't be constrained by debt covenants when you're trying to win AI networking contracts.
Exactly. You have to scale your manufacturing facilities instantly, and that leads directly into their core competitive advantage.
The vertical integration.
Right, which totally separates them from the assembly-focused competitors.
In the photonics space, owning the entire supply chain end-to-end is incredibly rare.
Extremely rare. They aren't relying on third-party foundries. They make the base materials themselves.
The indium phosphide and the silicon carbide wafers.
Yep. They fabricate the laser chips in-house and then assemble those chips into the finished 1.6T transceiver modules.
The material science part of this is critical to understand. Standard silicon just sucks at emitting light.
It's fundamentally inefficient.
Right. So for high-speed optical transmission, you need compound semiconductors like indium phosphide.
Because of its direct band gap properties.
Yeah. Exactly. It allows for the precise high-frequency light emission you need for 800G and 1.6T speeds.
But making indium phosphide wafers is notoriously difficult. The material is super brittle.
Yeah. Maintaining high yield rates is just an intense engineering challenge.
So by mastering this complex fabrication in-house, Coherent fundamentally distances itself from competitors.
Like applied optoelectronics or even Lumentum.
Right, who historically rely way more on third-party suppliers for those core chips.
And the financial impact of that vertical integration is huge. Because they control the full stack, they capture the margin at every single step.
They aren't paying a foundry markup on the wafer?
Nope. And they aren't paying a middleman for the laser chip. They just capture significantly more of the total dollar content inside every single AI server rack.
Plus, owning the fab protects them from supply chain shocks. When global demand for a semiconductor component spikes, they aren't scrambling.
And they've used that internal control to drive a massive manufacturing breakthrough, right? The wafer size transition.
Yes. They transitioned their fabrication process to use 6-inch wafers.
Which sounds simple, but in the compound semiconductor industry, moving from a standard 3 or 4-inch wafer to a 6-inch wafer is a geometric game changer.
It exponentially increases the usable surface area. They can output 4 times the number of chips per wafer now.
At roughly half the cost compared to legacy methods.
Exactly. And that scale allows them to aggressively price their transceivers to win major hyperscaler volume contracts while still protecting that 39% gross margin.
It paints a picture of a company just operating at peak efficiency. They're the undisputed leader in AI photonics right now because they can physically produce the highest-end tech faster, cheaper, and more reliably.
But then you know this is coming. With any hardware company trading at these multiples, perfection is often priced in. Looking at the flip side,
Yeah, we have to look at the historical reality of the optical tech sector.
it is notoriously prone to elevated volatility.
Boom and bust.
Right. We are dealing with highly cyclical capital expenditure cycles. Historically, telecom and datacom providers overbuild during the boom times,
Which leads to massive inventory gluts.
and then subsequent crashes in component demand.
And even though AI feels like this unstoppable secular shift, the underlying hardware supply chains are still subject to those exact same dynamics.
Absolutely. And the valuation certainly reflects peak optimism right now.
An 85% run in a single year pushes their market cap to $46 billion.
Right. So at that valuation, the market is pricing in flawless execution for the next 3 to 5 years.
Absolute perfection. If they stumble on a product roadmap, or if a hyperscaler delays a data center rollout by even 1 quarter, Rick,
The market could punish the stock severely.
we're already seeing some neutral sentiment scores and warning flags from quantitative models.
Institutional algorithms are detecting overbought conditions in the short term, despite the strong fundamentals.
That valuation premium makes their operational execution risk front and center.
Definitely. We talked about the strategic value of their in-house indium phosphide manufacturing, but maintaining that advantage requires relentless scaling.
Management committed to doubling their indium phosphide production capacity by the 4th quarter of 2026.
And expanding a compound semiconductor fab is incredibly complex.
You need specialized lithography equipment,
Ultra-pure chemical supply chains.
highly calibrated clean rooms. It's basically an engineering high-wire act.
And they are operating on a timeline that leaves zero margin for error.
None. If that facility faces regulatory delays or yield issues, or they just can't get the equipment.
They risk missing out on the critical window for those next-generation hyperscaler contracts.
And beyond the internal hurdles, you have the macro threats hovering over the whole hardware sector.
The physical reality of building these things.
Right, you have to move raw materials and finished goods across international borders.
So rising material costs or sudden shifts in global trade policy that acts as an immediate tax on those margins.
We've already seen tariff risks explicitly cited in recent analyst notes for other peers in the optical space.
Yeah. Coherent's vertical integration is a strong buffer against supplier price gouging, for sure.
But it doesn't immunize them from sweeping macroeconomic forces.
Not at all. If raw commodity prices spike or new tariffs hit, holding on to that 39% profit margin gets significantly harder.
It's a delicate balance. They insulated themselves from localized supply chain disruptions, but they are still heavily tethered to the global trade environment.
Navigating inflation, potential trade barriers, and an aggressive fab expansion all at the same time requires exceptional management.
So with all these dynamic variables in play, the growth, the cyclical risks, the capacity scaling, there are some major catalysts coming up in the next 30 days and through the rest of 2026.
Things that will entirely dictate the trajectory of the stock.
The most imminent one being the upcoming NVIDIA GTC Developer Conference.
For anyone tracking data center infrastructure, GTC is the defining event of the year.
It really is.
It gives the clearest forward-looking indicator of what the major cloud providers, the hyperscalers, are planning for their CapEx over the next 18 to 24 months.
And the scale of these deployments is just hard to overstate. We are talking about projects like NVIDIA's Vera Rubin architecture.
The gigawatt-plus data center facilities.
Yeah, a gigawatt of power is roughly the consumption of a mid-sized city.
All concentrated into a single cluster of AI servers.
The density is insane. The volume of data moving between the compute nodes at that scale is incomprehensible. Copper wiring simply cannot handle the bandwidth.
Or the thermal constraints at those speeds.
Exactly. Those gigawatt facilities rely completely on the specific high-end optical technology that Coherent makes.
So when announcements are made at GTC about the scale and timing of these next-gen architectures, it instantly signals to the supply chain exactly how much optical hardware is going to be needed.
And alongside that fundamental demand signaling, you also have to monitor the mechanical market forces at play right now.
The S&P 500 rebalance.
Right. We saw the immediate intraday price jump on the news, but the actual institutional buying takes time to fully execute.
Trillions of dollars in global capital are benchmarked directly to the S&P 500.
Every passive index fund, ETF, and mutual fund that tracks the index literally has to mathematically rebalance their portfolios to include Coherent at its new weighting.
It creates a structural, price-agnostic wave of buying pressure.
So watching the trading volume and block trades over the next month is going to reveal how smoothly this institutional capital is being absorbed.
That structural flow is a huge near-term tailwind. But looking further out, toward the second half of 2026, the ultimate fundamental trigger is going to be the anticipated surge in 1.6T transceiver bookings.
The step function surge.
Yeah, supply chain analysts are projecting a step function surge in demand. This won't be a gradual linear increase.
As the next-gen AI clusters move from the design phase into actual physical deployment, the demand for 1.6T transceivers, which are the absolute bleeding edge of optical speed, is just going to spike vertically.
And the market will get a very clear read on their ability to capture that incoming demand during their Q3 fiscal 2026 earnings report.
Which is expected in May 2026.
Right. And that report is going to be heavily scrutinized.
The consensus anticipates continued strong performance driven by these data center buildouts.
But the critical metric is whether they can sustain that 22% pro forma growth trajectory.
At a $46 billion valuation, any deceleration in revenue growth or margin compression.
The market will likely hit them with a severe contraction in their trading multiple.
Conversely, if management confirms that the step function demand for 1.6T is actually materializing and that the fab expansion is on schedule,
it fundamentally validates the entire bullish thesis.
It's time for the lowdown. Let's synthesize the core findings from today's conversation. The overarching narrative is that Coherent executed a highly disciplined corporate pivot.
They did.
They shed their legacy aerospace division, aggressively deleveraged their balance sheet, and positioned themselves at the precise bottleneck of the AI revolution.
Optical connectivity.
Exactly. By leveraging their end-to-end vertical integration from the raw indium phosphide wafers all the way to the finished 1.6T transceivers, they are capturing 17% overall revenue growth,
Driving gross margins toward 40%.
earning a spot in the S&P 500. They've engineered a formidable competitive moat, but the pressure is entirely on execution right now.
They must flawlessly double their physical manufacturing capacity by late 2026.
All while navigating a historically volatile hardware sector that is currently priced for perfection.
The transformation is undeniably impressive, and it leaves you with a compelling final thought to consider as you watch this sector evolve.
Yeah.
The market naturally fixates on the compute layer, the GPUs and processors that function as the brains of artificial intelligence.
Oh, of course.
But photonics and optical networking serve as the indispensable nervous system. As AI models become increasingly multimodal, processing complex video, text, and real-time environmental data simultaneously, they require exponentially more bandwidth to communicate across the data center infrastructure.
The data demand is staggering.
So as we advance deeper into this projected $16 trillion networking supercycle over the coming decade, will the companies designing the silicon brains continue to command the ultimate premium? Or will the hardware providers building the physical underlying connectivity infrastructure eventually hold the greatest leverage in the supply chain?
That structural tension between compute and connectivity is absolutely going to define the next era of infrastructure investment. Thank you for exploring this complex story with us today. That's the lowdown for today's conversation. As always, thank you for tuning in to the Easy Money Show. Don't forget to subscribe, hit that like button, and we will see you next time as we continue to make sense of the market's biggest moves.